Hey there, it's Dave of Flipper Force. Got our Flip Analyzer tool open. We've been launching a bunch of new updates to our Flip Analyzer tool over the last few weeks, and we just got done launching our new Flip Analyzer results page. So our new Flip Analyzer results page, it's going to take all of the values that you've entered into this step-by-step process. So you can see we've got 6 steps here that just basically walk you through the profit calculation here. So you've got your after repair value, you've got your purchase costs, your repair costs, your fixed costs, so your buying costs, your holding costs, your selling costs. Then you've got your financing costs, and then ultimately it calculates your profit. So basically you've got your after repair value of $300,000. So we think we can resell it for $300,000. We think we maybe can purchase it for $80,000. We're going to put $70,000 into it to renovate the property. We're going to have buying costs of about $1,600, holding costs of $4,500, selling costs of $24,000. And you can see if we go back to the financing section, we were just using a cash purchase. So in this scenario, we're just going to be purchasing the property with cash and then using our own cash to fund all of the renovation costs and stuff like that. So ultimately, you can see as of right now, if we purchased a property for $80,000, we'll have about $119,000 in profit in this deal. So if we go over here to the results page, this is just going to dive a lot deeper into how we came up with those calculated profit results, and then it's going to also show you how your project capital is being spent over time. So one of the first things you'll notice that we changed, you've got your flip stats up here, which are the most important stats with regard to your flip analysis. So you've got your ARV up there, your purchase amount, your calculated profit, and then the 70% rule. So basically, what is your current purchase price amount at based upon the 70% rule. So you can see as of right now that $80,000 purchase price is substantially below the 70% rule. So if we really wanted to take on more risk, we could probably increase our purchase amount. Otherwise, you get down in here to the project timeline. So this is a new widget that we added to the dashboard here, which you can use to basically show you the overall renovation period and the sales period. So basically what this is saying is we think it's going to take about 4 months to renovate the property. Once we get done renovating the property and actually put it on the market, it's going to take another 2 months to get that property sold. So overall, our total holding period and our project timeline is going to be 6 months. So if you want to, you can tweak this right here directly on the results page. So you could change that to 3 if you wanted to change the rehab timeline. You can see how that's going to change the overall project timeline now to 5 months, and then that would also affect our holding costs. So instead of the monthly holding cost being multiplied by 6 months, it's now going to be multiplied by just the 5 months. So we'll probably save, I think, $750 a month by reducing our overall holding period by a month there. Otherwise, you get down here into the project returns tab. So this project returns tab is basically just going to compare the current profit results. So again, the calculated profit based upon your known purchase price of $80,000. So basically what this is saying is it's saying if you purchase the property at $80,000, you're going to have $120,000 in the deal. But one of the other things that you can input into the analysis is your desired profit. So if we go over here to the final step, you can tell the app how much profit you want to make in the deal. So a lot of house flippers will shoot for a certain dollar amount. So maybe they want to make a $25,000 minimum on their project, or maybe they want to make a certain percentage of the resale value. So you could plug in that lump sum dollar amount that you want to make, or you can plug in a percentage of the resale value. So you can see right now, if we only want to make 15% of the resale value, that's only $45,000. So if we go back and compare that to what we had with our profit analysis, you can see it's going to recommend our maximum purchase price at $155,000. So in other words, in our current analysis, we were only analyzing a purchase price at $80,000, but if we really only want to make 45, we could actually offer up to $155,000 on this property. So right now is obviously a competitive time. So if you do need to sharpen your pencil and make a better offer for a property, this is going to kind of tell you, hey, you could actually offer up to $155,000 for this property and still make the $45,000 that you want to make on the deal. So what we could do is we could go back and say, okay, if they're recommending we purchase it at 155 to make 45, maybe we changed our purchase price to 150, so that's a little bit closer to what the recommended maximum purchase price is. So we're going to save that value, and then it'll update our analysis here. So you can see over here now we updated that purchase price. We're at $300,000 for after repair value. Our new purchase price amount is $150 with our repair costs at $70, buying, holding, and selling costs. So now our new profit's $49,000 based upon a purchase price of $150, which is a lot closer to our recommended maximum purchase price. So that's what these two panels are comparing. It's comparing the two calculations there. Again, the app automatically does two different calculations. It calculates your current profit based upon a known purchase price. And then it also recommends a maximum purchase price based upon the desired profit that you want to make in the deal. The next tab that we added was the Project Capital tab. So this new Project Capital tab is really going to give you a detailed breakdown of all of your project costs that you've got on the project over time. So you can see one of the new tables that we added was this project costs over time. So what it's doing is it's showing all of your costs, your purchase amount, your buying costs, your rehab costs, your holding costs, and then your selling costs across the timeline, and just showing you when you are going to actually incur those costs. So you can see at purchase closing, if we purchase the property for $150,000, we're going to have $3,000 in buying costs. So you can see at closing we're actually going to need $150,000. So that's how much cash we're actually going to need at closing, is $153,000. Remember, in this scenario we're an all cash investor, so that's why we're going to basically have to bring $150,000 to the purchase closing table. And then you can see over the course of the rest of the rehab here, we've got our timeline. So we've got a renovation period of 3 months. Again, remember our renovation was 3 months here with our sales period of 2 months. So that's really just what this is showing here down below. So you can see we have our renovation budget. Our total budget is $70,000. And that's basically just being evenly distributed across each of the renovation months. So we've got 3 months of renovation. 70,000 divided by 3 is equal to $23,333.33. So that's just going to be evenly distributed each month, from the first month through the end of the third month. And then we've got holding costs. So again, our holding costs are going to be our property insurance, our utilities, our taxes, our maintenance that we're going to have to pay during the entire holding period. So you can see we've got holding costs here for 5 months. Again, that's our entire project timeline, our entire holding period, and that's $750 a month. So you can see how we're going to have $750 a month over the entire holding period here. And then you can see our total project costs and what we're incurring each month. Again, you can see purchase closing, we've got $153,000 for our purchase and our buying costs. Then over the course of the renovation months, we're going to be paying both the renovation costs plus our holding costs. And then once we get done with the renovation, we'll only have our holding costs for the final month 4 and month 5 of the project. And then finally, when we go to sell the property, we're going to finally incur that sales closing amount of $24,000. So one thing to note is that the sales closing is actually not necessarily going to be paid for out of pocket. It's actually going to be paid for out of the proceeds of the sale. So one thing you'll notice here is we've got upfront project costs. So upfront project costs are basically all of your upfront project costs that you'll incur for purchasing the property, renovating the property, and holding the property. Again, that doesn't include that sales closing amount, because that's going to be paid for out of the proceeds of the sale. So if we were an all cash investor, by the time we get done flipping this house, we are going to have $226,000 invested into this deal. And that's going to, again, be all of the project costs here, your purchase, your buying, your rehab, your holding costs on the project. And since we are an all-cash investor, this timeline will show you how your funding comes into play. So we'll switch that up here shortly and show you how, if we switch it and add some funding in here, how that's going to be shown here on this project capital timeline below. But again, you can kind of see these are your cash outlays, and your net cash position is what the chart is showing down here. So in the very first month, you've got $153,000 in cash outlay. Then you've got $24,000 for the next 3 months. Then the very small expenses that you can't even really see in month 4 and month 5 are just your holding costs here. And this line is showing you your net cumulative cash position. So again, you'll see by the time we actually get to the end of the project, we're going to have $226,000 in this project. But then at sales closing, we're going to be reselling the property for $30,000. So now we're going to have a big windfall. So when you finally sell the property, that's when you'll get that income from reselling the property. So you're going to have a big inflow of money there, but you're already going to have $226,000 invested in the deal. So you're going to net $276,000, but you're going to have $226,000 invested in the deal. So your net profit in the deal is going to be $49,000. So that's how that works. Let's switch this up a little bit so that way you can kind of see how the funding comes into play. So we'll go back here to edit the analysis, and we'll go to change this to a loan. So let's set up a loan here, and we'll show you how this works. In our loan setup, you can set up a number of different loan amounts. You've got your purchase amount, repairs, purchase plus repairs, and ARV. One of the most typical ways that a hard money lender will lend for a property is going to be 70% or 75% of the purchase amount, and then maybe they'll lend up to 100% of the repairs. So let's just plug in 75% as the loan to value amount of the purchase. Basically what that's saying is the lender will lend up to 75% of the purchase value. So you can see they're only going to actually give us $112,000 up front, but we're going to be purchasing it for $150,000. So we're going to have, I don't know, $37,000 as a down payment that we're going to have to bring to the table at closing. Otherwise, they're going to be giving us all of the rehab funds here. Let's set up some points, or some interest and some points here. So let's just set up annual interest rate at 12%. We'll set up a number of monthly payments at 5, and then we'll do 2 points up front. Otherwise, we've got some advanced loan options here. So basically what you can do is, maybe we'll show you this first on the timeline, and then we'll come back here and we'll show you how this all changes. So let's do that real quick, and then we can show you what the advanced loan options does. What you'll notice here is that once you go down here to the project capital section, we've now got a loan line item, and we've also added in our interest payments and our points and other costs. So I guess if we stick up here, you'll notice that the interest payments are $1,800 per month, and that's going to be for the entire holding period here. So again, our total holding period is 5 months, so we're going to be paying interest payments of $1,800 per month. We're going to be paying those points that the lender wants up front, so you can see we're going to be paying those at purchase closing. So again, at closing, we're going to need $156,000, and then you can see our holding costs kind of went up per month for month 1 to 3, and then we've got additional holding costs here for our interest payments here for the monthly interest that we got to pay for the lender. Now let's get down into the project capital funding and investor cash over time. So this is really where the loans come into play, and it's going to show you how the loan funds that the lender is providing affect your cash outlay that you're going to need to bring to the table at closing, and then how much cash you're going to need over time during the renovation and remaining holding period. So you can see again project cost, that's going to feed from the top. So we've got $156,000 in project costs that we need to pay for at closing. Again, that's our purchase amount, our buying costs, and our points and other costs. And you can see, but the lender was only going to give us $112,000. So again, that was 75% of the purchase amount. So basically we're going to have to provide that cash to pay off that down payment. So that 25% down payment is what we'll need to bring to the table. Plus we're going to be paying the buying costs and the points out of pocket. So ultimately that's going to be about $44,000 is what we're going to need at closing. Then you can see the lender is providing the funds for the rehab and renovation costs. So you can see we've got $25,000 again in project costs. That is $23,000 in rehab costs plus our holding costs of $750 plus our interest payments. So we've got a total of $25,000, $25,900 in month 1, 2, and 3, but the lender's only going to be giving us $23,000. So basically they're going to be giving us the rehab funds as draws. So you are kind of going to be going a little bit out of pocket there, but as long as they reimburse you pretty quickly for the rehab funds that you're paying there, you're really only going to be paying for the holding costs out of pocket. So you're receiving these rehab funds as draws each month is what it's showing. and so you're only going to have to pay the holding costs here. So now you can see how that affects your overall cash outlay. Again, you're going to have to come up with a pretty big down payment, a 25% down payment. You're going to have to pay some buying costs and some financing points up front. Then over the course of the next 3 months, you are only going to need to be paying the holding cost during the renovation, because the lender is going to be giving you the funds for the rehab amount. And so again, you can kind of see in month 4 and 5, you still have your holding costs. And then you can see in this final sales closing, this is where you're going to sell the property, and then you're going to have to pay the sales commission, so paying off your sales commission for your real estate agent, so that $24,000 up here. And then you're going to need to pay off your loan balance of the loan. So you've got your loan amount here, which was $182,500. So you've got $300,000 as your net proceeds that you'll get from reselling the property, minus your $24,000 for your sales commission, minus the outstanding loan balance that you have to pay off. So overall, when you go to closing, you're going to get a nice big check of $93,000, but you had $57,000 of cash, your own cash invested in the deal, so you'll make a net profit of $36,000. So you can see that's what this is. These stats up here at the top are showing you. You've got your cash that you're going to need at closing. So again, you're going to need $44,000 at closing. Over the course of the project, you can see you've got your cumulative net cash position. It's starting to grow just a little bit from those holding costs that you're going to have to be dumping into the property. And then finally, you're going to have about $57,000 invested in the deal by the end of the project. And then once you get that check from the lender when you go to sell the property, or from the buyer when you go to sell the property, you're going to get a nice payday of $93,000 and the net profit of $36,000. And again, this chart down here at the bottom, this is going to show you that cash outflow or inflow over time. So you can see again, we've got a big cash outlay at the beginning here for our purchase closing, and then over time we're going to be paying off some holding costs here. So our net cumulative cash position is going to gradually get more and more invested into the deal until finally at sales closing we get our big payday of $93,000 and a net profit of $36,000. If we go back real quick just to show you those advanced loan options, let's show you how the advanced loan options kind of outlay that information for your points, your interest payments, and your rehab funds up front. So we've got some default settings here. Basically, most hard money lenders are going to want their points up front. But if your lender allows you to wait and pay off those points at the end of the loan, you can change that setting to have those points paid at the end of the loan. And what you'll see on that project cost over time table is those points are now going to shift to the end of the loan. Instead of being at the purchase closing, they'll be at the sales closing. Same thing with the interest payment schedule. Some lenders, or most lenders, will require you to pay monthly interest payments during the entire holding period, but otherwise some lenders may not require those interest payments till the end of the loan. So if you change it to end of the loan, then you'll see all of those interest payments kind of become a balloon payment at the end of the loan when you go to sell the property. And then finally, the rehab fund schedule. So most lenders will hold back the rehab funds as draws and not distribute those funds to you until you've actually installed the renovation and completed the repairs on the property. Otherwise, some lenders may just give you all of those funds up front. So if you change that to upfront, those funds that you receive from the lender will land in the purchase closing column. So let's show you that real quick. If we go over here to project capital, you'll see that the interest payments, we changed that so that the interest payments won't be paid for until the final month, essentially. Same thing with points and other costs, is they're landing in the final month, so that's when you will pay off those points and interest. And then if you go over here to the loan funds, we had our rehab loan funds. We're getting all of those funds up front. So if you remember, I think you can scroll down here and you can see what those loan funds actually were. We were getting $112,000, which was 75% of the purchase, and then we were getting 100% of the rehab amount. So we are getting a total of $182,000. Previously, we were getting those distributed as draws for month 1, 2, and 3. Now, since we changed it to just give us those rehab funds up front, it's all landing in the purchase closing. So now you can see we're actually going to have more money at the beginning. So we're actually going to have a positive amount of cash. So they gave us more cash than we actually needed. We only needed $153,000 at closing, but they gave us $182,000. So you can see down here we're actually net positive. And then as we start to spend some money on the project, you can see how our cumulative net cash position starts to go below zero, and we gradually end up with a cumulative cash position of $57,000 into the project. So that was a overview of our new project capital over time chart that we've added to the results page. We've also added in those advanced loan options there directly on the financing tab. So if you really do want to build out a customized loan structure where your lender might do some different things that are kind of atypical from what the industry standard is, you can always customize those advanced loan options as well. Hopefully you like those new additions. If you do have any questions or suggestions, let us know.